All right, let's talk about something that's happening all around us, all the time, whether we notice it or not. We're diving into the world of foreign exchange, or as most people call it, Forex. It's this huge, invisible market that affects everything from international business to the price of that phone in your pocket. So today, we're going to pull back the curtain and see what it's all about.
I want you to just look at this number for a second. $9.6 trillion. It's a number so big, it's kind of hard to even process, right? To give you an idea, that's more than the entire yearly economic output of Japan and Germany combined. And that's not some annual figure.
No, that's the amount that changes hands on this market every single day. So what is it? What could possibly be worth that much daily? Is it stocks? Oil? Gold? Nope. The answer is actually much, much simpler and way, way bigger. It's money itself.
We are talking about the foreign exchange market. And when I say it's big, that's an understatement. It is, by a massive margin, the largest financial market on the entire planet. The New York Stock Exchange, a drop in the bucket by comparison.
So what is it really? Well, simply put, the Forex market is where one country's currency gets swapped for another's. But there's no central building, no single trading floor. It's this giant, interconnected digital network of banks, financial institutions, and traders all over the world. And because Tokyo is opening as New York is closing, it literally never sleeps during the week. It's a 24-hour-a-day machine.
Okay, so we've got a massive 24-hour market for currencies. But how does it actually work? Like, what are people actually doing? To get that, we need to break down the 3 fundamental ideas behind every single Forex trade.
First thing you have to know, you never just trade the dollar or the yen. In Forex, currencies are always traded in pairs. Think of it like a constant tug of war between two economies. If you see EUR/USD, you're looking at the battle between the euro and the US dollar. You're basically betting on which one is going to pull harder. The first one listed is the base, and the second is the quote. That just tells you how many US dollars it takes to buy 1 euro.
Now, these currency values move in teeny tiny little steps. So how do you measure those movements? Well, that's where something called a pip comes in. It stands for point in percentage, and for most currencies, it's the 4th number after the decimal point. That's a super small change, right? But as you're about to see, those little pips can add up to mean a whole lot of money.
And that's because you're not just trading 1 euro or $1 at a time. That would be crazy, right? Instead, trading is done in standardized chunks called lots. You know, it's kind of like when you buy a carton of eggs. You don't buy 1 egg, you buy a dozen. In Forex, a standard lot is often 100,000 units of a currency. So now you can see how a 1 pip move on a 100,000 unit lot starts to become pretty significant.
And this leads us to maybe the most powerful, and let's be honest, the most dangerous concept in Forex: leverage. Basically, leverage is a loan your broker gives you. It lets you control a huge position, like one of those 100,000 unit lots, with only a small amount of your own money. It's like a financial magnifying glass, and it cuts both ways.
And I really can't stress this enough. Leverage magnifies everything. A tiny price move that goes in your favor can mean a massive profit compared to what you actually put in. But, and this is the part you have to hear, the exact same tiny move against you can create devastating losses. We're talking losses that can completely wipe out your entire account, and then some. It is a true double-edged sword.
Okay, so we've got the key concepts down: pairs, pips, lots, and that big one, leverage. Let's put it all together and see what an actual trade looks like from the moment you click buy to the moment you close it out.
Now, whenever you look up a currency pair, you're going to see 2 prices, not one. There's the ask price, which is what you have to pay to buy it, and then there's the bid price, which is what you'll get if you sell it. That little gap between them is called the spread, and that's basically the broker's fee for the trade. The important thing to remember is you always buy at the higher price and sell at the lower one. So every trade you open starts off slightly in the red.
So let's put it into practice. Imagine you've got a feeling the euro is going to get stronger against the dollar. The ask price is 1.1200. You decide to go long. That's trader talk for buying, and you buy 10,000 euros. That costs you 11,200 US dollars. And hey, your hunch was right. The price climbs up 100 picks to 1.1300. You decide to close your trade by selling the 10,000 euros back, and you get $11,300. Boom, you just made $100. Sounds pretty straightforward, doesn't it? And that's the appeal. But now we have to get serious for a minute and talk about the most crucial part of all of this, the reality of risk. It is so easy to get mesmerized by the potential profits, but you have to understand who you're really up against in this market.
So take a look at this. The Forex market is completely dominated by the big dogs. Major banks and other massive financial institutions, think hedge funds, central banks, they make up 96% of all the trading. Retail traders, everyday people trading from home, we're just this tiny little 2.5% slice of the pie.
And if that doesn't put things into perspective, this will. This isn't an opinion. This is a hard fact from the UK's main financial regulator. A staggering 80% of retail traders lose money. Let that number just sink in for a second. It's a tough, tough game, and the stats prove it.
So given how incredibly difficult it is to succeed, it probably won't surprise you that this world is also full of scammers who are looking to take advantage of people's hopes. So let's arm you with some knowledge. Let's talk about the red flags you absolutely have to watch out for.
Okay, here's your checklist. The number one biggest red flag of them all. Anyone, and I mean anyone, promising you guaranteed high profits with little or no risk. It just doesn't exist, period. Be super careful of anyone pressuring you to deposit money right now, or anyone selling a secret trading robot that never loses. I mean, come on, if it was that good, why would they be selling it? And always, always check if your broker is regulated by a government agency. And if you ever have trouble getting your own money out, that's not just a red flag, that's a giant flashing siren.
So here's the real takeaway. The Forex market is this incredible, powerful force in our global economy. There's real opportunity there, for sure, but it demands respect, it demands education. The market isn't going anywhere. It'll be open tomorrow and the day after that. The very first step isn't to open a trade, it's to open a book. It's to learn. Your first and most important investment shouldn't be your money, it should be your time.